Everyone. Welcome to this webinar on Wednesday. First of all, thank you everyone for joining in. Payment fraud has been growing exponentially, and I believe it hit about 22,000 crores this past year. What we want to do in this webinar is really, as the RBI is shifting its has its vision 2028 from growth at all costs to accountability at all costs. In a sense, the AI that allows us to onboard our customer in seconds, and we are all sort of betting on big on this, is also being weaponized to create these synthetic personas and deepfakes at scale. Before we really get into this conversation, I would want to take just a couple of minutes to introduce our panelists. With us, we have Saurabh Srivastava. He brings over 2 decades of experience in the corporate banking and risk management functions. And today he is the Chief Risk Officer at Unity Small Finance Bank. Welcome, Saurabh. What I'm going to do is maybe start with you, Saurabh. Just a quick summary on what are your key takeaways from the RBI's Payments Vision 2028 and the safeguards that they've discussed to curb sort of digital fraud?
Just as in terms of a perspective, I think RBI is taking the right measures because of the fact that we are turning out to be the economy which is adopting digital payments in the largest manner across the world. 50% of the overall transactions in terms of digital payments are happening here in India. That has to do with the size of our economy as well as the us being the largest democracy in the world. But yes, it has been very, very heartening to know and to receive the feedback from counterparts which are there in different other countries that the digital adoption of payments here in India seems to be at a much, much more advanced level than we see even in economies like the US. Also, uh, given that fact, there is been a huge increase in the frauds which have been happening in the digital payments segment and the other modes of payment which use the digital format, because of which the RBI has correctly been concentrating on the various measures that are required to control the digital payment frauds. There are very obviously special attention which is being paid to a much more vulnerable segment, which is the senior citizens. And we've now been seeing a lot of news about how they're being conned into parting with their money to fraudsters, and they're just becoming very, very innovative. Mule accounts happens to be another area where there is a huge amount of focus that is coming in, not just from the RBI, but all the way from the Home Ministry of the country, which is, I believe, the right thing to do. The measures that RBI has come up with is a lot to do with what they see in other advanced economies, which are basically being able to control this particular piece. Now, when you see the directions which have been released by RBI, they're quoting a lot of economies or a lot of measures which have been taken in other economies in terms of lag of payment or coming up with special segments for vulnerable or more people who are more prone to cyber frauds because they don't understand technology very well as the fact that they are trying to now set up guardrails around the AI piece, which to my mind is something that Europe has taken up very, very significantly. They've in fact decided to move to Basel IV, which requires an active amount of monitoring of what the AI models are doing across the bank and what exactly are their vulnerabilities across the world. So therefore, all the steps that RBI is taking is to bring us in line with what is happening in the rest of the world, as well as to concentrate on a very, very critical area, which is this digital payment frauds piece, which is now emerging as one of the more significant risks that any financial institution, may it be small or big, faces. So all of these are very, very welcome. However, as we've seen here in India, the adoption of this particular set of payments or measures happens to be something which takes a little bit of time because of the fact that, the number of participants is just too large. The kind of changes that are required is also very, very large. So therefore, it is going to take a little bit of time, but I think all of them are very welcome. That's the sort of summary that I can actually come up with.
No, I appreciate it. And I think, like you said, it's definitely a welcome step in the right direction. And also more importantly, the fact that we're talking about it and it's becoming a part of the agenda, I think that's important to highlight. I still think we have ways to go, but I think we're in the right direction. We keep talking about the zero friction onboarding, and I think everyone is and this has been the refrain I think for the last few years, like, oh, I want to reduce friction. I want to make sure there is nothing in the way for someone to get onboarded and get the services they need. But yet, obviously a lot of AI is being used for that, but at the same time, because of AI, we're getting the synthetic frauds and deep fakes and sort of takeovers. So how do you scale without really opening up the floodgates so that you don't get the bad actors in, but you still sort of balance that zero friction type of model?
So, see, my thoughts echo what he was actually saying, but what we have to see or what we have to look out for is the development of these behavioral models. Now, when we start looking at onboarding and we are turning around and saying that, the restrictions or friction, as you used it, has to be lesser and lesser because that's the kind of service that the new generation of customers is actually expecting from a lending institution. There is different formats as far as lending is concerned. Now, when you start talking about in terms of just simple onboarding, when you're looking at customers which are completely retail, that threshold could be devised by the companies on the basis of their risk appetite. When you're looking at retail, you have to now start looking more and more into classifying your customers into high risk and low risk. And then you have to decide what is the level of friction that needs to be given to a particular customer. Friction in itself is not a bad word because of the fact that it is this friction which is helping us to control the risk of bad actors being onboarded. So, therefore, what is going to be the level of friction which is going to be required is something which is to be decided, and then there are various models available in the ecosystem, as well as there is a lot that can be developed by the banks and the NBFCs because of the fact that they're large enough to have their own databases to be able to decide that. That's what's going to happen. Now, the moment you start looking at behavioral models, therein there is some amount of subjectivity that creeps in into this whole process. To my mind, this subjectivity is what has to be continuously looked at and has to be continuously refined for this model to become better. So, to summarize, what I'm basically trying to say is that friction is not a bad word. It just has to be decided on what level of friction to give to whom, and to be able to figure out what is the kind of onboarding that you're actually doing. And then the other one is that there is a continuous need for us to continuously keep refining what our models are, for us to be able to turn around and say that, yes, now we are at a comfortable level where we can comfortably turn around and say that, yes, we are going to be more or less there in terms of not being onboarding the bad actors, so as to talk about that, as well as to turn around and to be able to say that, yes, there is a acceptable level of threshold or risk acceptance that we've reached at this point of time. Now, those are things that are easier said than done, requires a lot of let's say, let me use the word friction one more time, which is which is internal as well as external. Now, the internal friction is what we also need to continuously keep looking at, because it has to be balanced between what is it that your growth ambitions are and what exactly are the control ambitions that you actually have, or what exactly are the control factors that are being put to you by the regulator. So all of these factors require a huge amount of change of thought process, change of culture, change of attitude for us to be able to control this whole process.
No, I think fair, and I want to sort of maybe just quickly summarize what. And I completely agree. Friction is not a bad word. I've always thought friction is not to be used in a way that it's about ensuring that the system is safe for both the consumer as well as the company. So it's actually doing a favor to the consumer as well in the long run, because the safer the system is, the better rates they can get, and all of those good things that get unlocked for them, I think. The one challenge, of course, and I think is that to do some of this, you need connected systems, right? To get the right kind of signals, I think the key is to get connected systems in place which can derive data from a lot of places, and then create that risk model to classify and segment the customers based on spending patterns, the size of loan, and a host of factors that you may sort of put in there. In terms of the BNPL space, right, where obviously that's a very fast moving, not very large amount of money, but it's at a massive scale. There everyone's looking for that one click experience. Oh yeah, I walk into a store, I want to get a loan, and I want to buy something, I just quickly get it done and move out, right? So how do you look at stopping that fraudster? What are some things that you're looking at and then you've thought about, which can probably protect the company?
I think
Is more on the card issuing side of things, right? Because basic video KYC is being done, but now with the digital mass and all that coming in, what are some things that are being done in the space to prevent some of this fraud?
Uh, Largely, what is basically happening at this point of time is that, yes, we have the traditional databases, which is the bureau and the bureau related data, as well as what has been the kind of past track record with other cards, which is again something that you get out of the bureau. There is a huge amount of alternate data which is actually available at this point of time. And in alternate data in itself, there are various ways in which you can now start looking at how exactly does a factor play out with the bad rates, so to say. So, for example, I mean, if there is a person who is ready to give you as much of contactability as is required, let me just use an example. If, let's say, a customer is ready to give you his mobile number, and this mobile number is also something which is registered on a lot of e-payment gateways, as well as on a lot of marketplaces like Amazon, that kind of gives you a sort of sense of uh, uh, a sense of the fact that he's giving you the right number, and this is a person who's not uh, trying to give you the minimum amount of details and skip the moment you've given, or the moment
Right.
you've given them some amount of money. So this is just one example of the alternate data that can actually be used for you to turn around and figure out who are your good customers and who are your bad customers. More and more and more, you have to start deciding who are your high risk customers, who are your medium risk customers, and who are your low risk customers. At any given point in time, any organization would ideally like to onboard the low risk customers only. Everybody is vying for these customers, and also the fact that there is a huge amount of, let's say, impetus on growth. So therefore, there are going to be various levels of customers that you will have to onboard. It's just that you have to know what is the kind of customer that you're onboarding, and then you have to decide what is the level of checks that you're actually going to put in. Now, those level of checks could actually come in from both the traditional data sources that you have, as well as the non-traditional data sources that you have. And believe me, there is a host of data which is available, which is now allowing you to have a look at what is the kind of behavior the client is actually displaying in the market. Is this a client who is just simply trying to take a loan and move away from you to, let's say, skip? Or is this a client who is actually genuinely taking loans and has a behavior where they actually rely upon loans to actually meet their needs, and they have been very, very regular in repaying those loans, and that's the way their lifestyles are at this point of time. So usage of alternate data is a very, very big thing that needs to be done. Also, I believe that the government of India is doing a lot of things for us, for data to be available to a lot of lenders, and very, very quickly. So if you are logged into the various databases that the government of India is providing, whether it is about fraud, whether it is about mule accounts, whether it is about defaulters, all of this is databases which are going to be helping you onboard the right customers. Uh, One of the things that everybody's been talking about is the usage of AI or machine learning into this whole process. My take on that is that AI and ML are not really doing something completely innovative. They're doing something much faster than what
Right.
a human or a regression based model can actually do. So therefore their utility also comes from how do you train these models. So therefore there is a lot of work which is actually being done in terms of training these models, which is something which is also going to lead to a very, very good results.
Right.
So for example, I mean, there was a conference that I attended where people from the Netherlands are talking about the fact that they now have the ability to be able to determine what is the kind of energy a household is using, and basis that energy they are able to also determine what is the kind of payments that they're doing for various utilities. And if there are people who are doing these payments to various utilities from a particular address, that basically means that the contactability is high. Also the fact that if this person has the ability to pay for such utilities, then there is an ability, or there is an underlying ability to be able to take loans and repay them. So these are alternate uses, or these are uses which are being brought about to look at customers and to essentially classify them as high, medium, low risk, or whatever other
Right.
format that one can come.
Yeah, that's a very interesting example to look at household electricity usage to say, look, you have the ability to pay, and I'm sure because it's pretty cold there that you have the ability to pay the high fees, so you must be a pretty reasonable risk. So the risk will be low, and like you said, even contactability becomes because that's obviously another big challenge post giving out and lending. Now, if you look beyond just the see, we've been talking a lot about, of course, we started touching upon alternate data and all of that, right? But typically so far, and I would say not so far, but the traditional way has been identity-based verifications, right? Now, this is for both of you. There's also, I think what I'd like you to maybe talk about a little bit is beyond the technology. Are there things in the organization and maybe even in the industry that are required to build some sort of a resilient fraud defense system, especially as AI gets smarter, AI gets cheaper, and we're starting to see these organized, it's almost like companies that are being run to run, mule accounts and to defraud people.
What I believe needs to happen is a lot of re-looking at what your understanding of business is. So when I say this, what really happens is when you start looking at pure data and data-driven associations, there is a lot of insights that come out which normally you wouldn't have thought of. Now, it is upon humans to basically turn around and accept that. And those acceptances, to my mind, is one of the biggest hindrances that I've seen across organizations. There are going to be certain associations which are going to come out. Those associations are going to be very, very new, things that you may not have thought of earlier. And then what really happens is it's upon you to be able to try and see how can you utilize it. That's the biggest thing that
Yeah.
we are now seeing happening around here. Now let's try and look at some of the pitfalls that we have. What are people turning around and saying are the biggest problems that AI has at this point of time? The biggest problem that AI has at this point of time happens to be training. You have to train it correctly, otherwise it has a tendency to hallucinate.
Right.
And by the time you catch those hallucinations, because of the fact that it's taking let's say a billion decisions in a second and things like that, or it's considering billion factors to take a decision within a very, very short span of time, these hallucinations are very, very difficult to catch for the humans, and it is something that we have to continuously keep looking at. So as I said, and I've said this earlier and I would like to repeat this, the idea basically is that everybody's job now has to become from a doer to a supervisor. So there are a lot of jobs which are actually something that AI can actually take up. And it is for people to start now looking at supervising, or looking at what AI is doing to be relevant in today's world. Uh, these hallucinations are very, very strange. They become, or they can cause very, very big problems as far as lending institutions are concerned. There is a lot of false positives that can come out of these hallucinations. And these hallucinations, while in a lending institutions, may just lead to, financial problems. I mean, financial problems or financial losses are a big problem. But however, when we start using AI in potential, let's say life or death situations, there the significance of these hallucinations become much, much more higher. So, two things that I have to kind of say that are the changes that organizations need to bring about. One happens to be being able to understand and being able to accept what are the associations that you're getting out of AI, or what are the results that you're getting out of AI driven data analysis. And second happens to be just very quickly shifting over to becoming a supervisor and to be able to control and train this model correctly. Those are the two adaptations that every organization needs to bring about.
Yeah, absolutely. I think that your point about us becoming sort of most of us becoming now supervisors is very very apt, because I think that's what's going to happen. As they call them, call ourselves tastemakers or whatever you want to call it. But we're going to have to be the ones that actually make the final decision based on what has been surfaced, and having that sort of human intuition and knowledge to say that, yeah, this seems right or this seems wrong. I'll quickly switch a little bit to sort of. Uh, this whole concept of as we put this into play, and we're in the execution phase and setting systems up, how do you even start to identify a potential bad actor before they even either spend their first money or they get the first payout? Are there now new systems in place that you're looking at that may help identify this? Yeah, no, I think, interestingly, we've been hearing this a lot, and we've also been pushing this concept a lot. But I think that it's unless maybe a regulator steps in genuinely, or an SRO, like you said, has enough clout to get the different entities together. This has been a problem where, it's sort of that first mover. Who's the one ready to do this? Who's the one ready to submit the first list of fraudsters so that now it can be shared between the companies? I think that's a challenge to be solved. Saurabh, in sort of the world of UPI, right? We're saying obviously UPI is just taken off. But how do sort of in your world, from the credit card side of things, how do issuers position themselves to drive sort of better user engagement and deeper customer loyalty? So what's the modus operandi for your side of the world?
Uh, it hasn't really changed too much. The way it actually works at this point of time is to be, first and foremost, identify your customer and be able to identify the needs that these customers have at this point in time. Now, for you to be able to get more and more customers, there are two problems that you're trying to solve. You're trying to solve one, which is basically to try and get more and more customers and to be more and more user friendly to customers. And the second thing that you're trying to solve is that in a world where everything now is becoming more and more, let's say, non face to face, and it is just becoming online, how exactly do, or what are the guardrails and the checks that you put in place to be able to make sure that you're interacting with the right lot. Uh, to my mind, what is actually happening, and just to go to your previous question also, in both of these segments, UPI as well as credit cards, as well as the digital loans that we're actually doing, there seems to be a huge body of work which is actually now being put in to identify behavioral analysis. Now, when I say behavioral analysis, I don't just mean behavioral analysis on your financial repayment or your financial obligations, behavioral analysis of your general behavior across your social media in print. That today is being used as a database for a lot of predictions to be able to figure out whether I should be providing you a credit line on UPI, or whether I should not be providing you a credit line on UPI. Because what is actually happening is that the decision timeline for all of these, for me to provide a loan to you, is becoming smaller and smaller and smaller. The moment it becomes very, very minuscule the way it is at this point of time, then the decision factors that I have to use have to be limited, but they have to be the right ones. So therefore there is a lot of work which is actually being put in terms of that. Plus, there is a whole huge impetus on trying to find the right market and a newer market. So earlier, when we used to turn around and, traditionally, when we used to look at models, we used to turn around and say that your target audience is people who are aged between 25 to 55, because a person at 25 would possibly have his or her first job. And then, 55 is where, people are moving towards more savings rather than taking loans, because of the fact that they're now reaching a retirement age. However, there are now models which are available, which are turning around and saying that you can actually lend to a 20-year-old as well.
Yes.
You just have to be able to figure out the right criteria for being able to lend to a 20-year-old. Now, those criteria may be very, very different from the ones that we are traditionally seeing at this point of time.
Yeah.
And those could also be just simply about what is the kind of interactions that he or she has with the rest of the world. So those are things which are now being looked at, and there is a huge body of work which is actually being put in. Just the other day, I was actually reviewing an organization which is actually talking about looking at your facial features and be able to determine what is going to be your financial behavior. And believe me, while that may sound something very, very far-fetched, they had data to prove that that is something that is actually working for them. And it was very interesting to be able to sit across and listen to the fact that somebody who is doing a VKYC with you, his or her expressions can help you
Yes.
determine whether this is a person who's going to be a good actor or a bad actor, and to be able to do this. So lots of data which is available, lots of good work which is actually being put in. And as Mazen, I may sound a little conservative, but I'm quite excited with the way things are moving around here. But however, as a risk officer, one of the things that you want to look at is that you want to look at reams and reams of data before you take a decision, and then let this thing roll out and to the open. Because once you let it roll out, it's almost like a rolling stone down with uh, and it doesn't catch any moss and whatever else you want to put across in that argument. So the other thing that I notice, and this is something that I think is something which is going to require a huge amount of change in terms of thinking, happens to be the fact that one has to now start looking at a sea change in terms of transactions. Earlier, you were people who were, or of as a financial institution, you were a set of people who were making these transactions or these transactions happen. Now you are a set of people who are looking at what is the nature of the transactions which are happening, and what do you need to do about that. Is this something that you need to expand on? Is this something that you need to curb up on? Or is this something that you need to just simply sit back and observe for some time? Now, those are very, very difficult decisions to take. So that's the change that I see that needs to be brought about in the thinking across the board.
No, I think
Only for UPI, actually.
yeah, I think very fair points. I think as you were talking about it, one of the things that's also changing is I think the standard types of jobs that people have, right, and sources of income is changing. So you can't really rely on the standard way of saying, hey, what's your salary slip look like, and maybe you are good enough, right? With the gig economy and with this creator economy that's happening now, that's you have to sort of also now the models have to evolve, because the models will spit out and say not a good risk. And then you sort of have to adjust for that because this is the new world we are in. As a last question and to wrap up, as you look ahead, sort of 2026 and beyond, and obviously with everything happening around us, a couple of things I want you to talk about. One is, what are the opportunities that exist? and what are the challenges for the issuers in India specifically? And then what do they need to do to actually be prepared for the next wave of innovation slash regulation that's going to follow that innovation?
So, a couple of personal things that I'm actually looking forward to, and then there are a couple of organizational things that we'll be looking to. A bit of a background, when all of us were doing our MBAs back in the day, we used to be very fascinated by the commodity traders and the investment bankers, because we all had that image of this person sitting with some 6 live screens and taking real-time decisions and things like that. And I think that's where AI is going to drive us all. Even while being in a risk job, my job is probably going to be somebody who's sitting with 7, 8 different screens, monitoring 7, 8 different sets of streams of data, which is actually flowing out on a real-time basis, and to be able to kind of take decisions on the basis of what this data is actually trying to tell me. Uh, Other than that, what I do look forward to is a model, or is a space where we are going to be turning around and saying that there is a lot of uh, stuff which can actually be undertaken, which we never really thought was were possible. There are going to be a lot of markets which are going to get opened up, because of the fact that we are now ready to just simply look at the data that is coming out of that particular segment, and we are being able to take decisions basis on this data, because of the fact that the data that used to come out used to be in such varied pockets, and used to be so much of uh, unjointed kind of data which is available in so many different pockets, which is something which can now be consolidated with the help of AI. It can actually pick up the relevant data from the relevant resource, and it can actually do this in a much, much more faster manner than it is humanly possible. So therefore, there is going to be a huge expansion of what the market is, or how the market, or how do we perceive the market, or what exactly is going to be the market for all of us. And also the fact that there is a lot of excitement about the fact that today you can actually use data for decisions which you never really thought were possible. Now, just as an example, this is an example that I kind of keep using every time I go to talk somewhere, and this may be used a lot. So, uh, one of the first times that I inquired, or I interacted with somebody who was using a AI or a ML model, they turned around and told me that, we launched a particular model, and what it started doing was that it started making associations that, if, let's say, there is a unit of a husband and a wife that you actually lend to, what the model starts showing, or the data started showing, was that if the wife was more qualified than the husband, then there was a higher chance of a bad rate happening. So if the husband was more qualified than the wife, loans would run fine. If the husband and the wife were qualified equally, the loans would run fine. But if the wife was more qualified than the husband, then there was a bit of a association with a higher amount of bad rate. Now, what did the AI model start doing? The AI model simply started understanding what it understood about qualifications, and it just simply started rejecting certain loans to people because of the fact that it thought that a particular qualification was lesser in comparison to another qualification. Then what it did was that it started associating certain qualifications with certain communities, and then it started refusing loans to those communities. Now, all of these happen to be a hallucination of a model, and that, to my mind, is quite an exciting field to be looking at, because of the fact that what you're trying to do is that you're almost trying to look at a 15-year-old who has a mind of a genius and is probably on anabolic steroids or something, and you're just trying to make sure that they understand what morality is all about. So to my
Right.
mind, that parenting is what the job is going to become, and that is quite exciting.
Yeah, it's interesting you say that. Now I feel like I'm underprepared. I don't have kids, so I think I'm at a loss now on how to be in this new world. Um, but thank you so much. I think this was super enlightening, and I think there's some very interesting points that both of you made. And I think the underlying point is obviously that friction one is not a bad thing. I think there's ways now to reduce the friction, keep the bad actors out at the same time, and sort of manage the business itself and make sure that the business is profitable. And I think looking forward, like you said, One is how do we, with the limited set of data that we have, start to, maybe service these underserved segments that were always ignored because, well, I don't know enough to lend to them, but now we're able to find maybe different patterns and ways to maybe get them into the financial fold. And also, of course, the way AI is looking at relationships and patterns, that's another exciting bit. What I'll do is maybe I'll take one question. I think there were many questions, but I think one question I want to take, maybe that would be interesting from both of you, just maybe 30 seconds each. This was what's one fraud vector today that most issuers are underprepared for and probably will become mainstream in the next 12 to 18 months. Any thoughts on that?
Identity setup is something that I think is a vector that we have to very wary of, because of the fact that the means and ways available to a person right now using AI and other technologies to be able to do a setup fraud is something which is becoming a huge problem for us to solve. It could be as simple as somebody, just hiring a hotel room and creating a office environment and, kind of defrauding you, or to somebody who is using a more finer tools to be able to manufacture documents and to be able to defraud you. So these are things which, to my mind, is, if that one factor is what we're going to talk about, then that's the one factor that I think we are quite underprepared for, and we need to get prepared for.
Yeah.
More.
No, I agree. And I think because we do this day in and day out, one of the things that we've seen and I think I would say in some ways, thankfully, we haven't seen a lot of it. There's still very limited because, I mean, there is a little bit of sophistication still required, but I think that barrier is getting smaller and smaller. And so we've already put things in place to prevent deepfake and from identifying. I think visually it's very hard to tell. It's almost near impossible now. I think you have to use technology to sort of fight the deepfake battle. And especially in video KYC, like you said, and I think, for us, if I were to look at one threat vector, as Saurabh sort of also pointed out, they've always been organized, but I think now they're getting organized to a next level. And I think with the ability of technology to give you access to information, data, setting up, false businesses and all of that, I think that's going to be a big threat vector that I think people need to really start to put more thought around, because we are seeing this starting to happen in a lot of pockets within India, where there is a concentrated effort of people setting up genuine businesses, and they're waiting 10 months. They have no problem waiting for a while because they know this is going to be a big score. So they're sort of doing that very, sort of patient fraud, if you will. So that's something I think we definitely should all be aware about. But I know we've gone a little bit over time. I really thank you so much for your time, and definitely a lot of hopefully learnings for folks that have been listening in, and I think there's a lot of things to think about as well, as we go into this new year and beyond, and start to fight this whole AI world that we are living in. So thank you very much, and I really appreciate your time. Thank you.
Thank you.
Bye bye.